Super. So we're ready to go. We've got 15 minutes, so I'm going to dive right into it. The first two slides are essentially to give you an overview of Mazi. It's our 20th year anniversary this year, so we've been in the business for a while. We have just over 51 billion rands worth of assets. And I think the most important takeout or call out is that we have capabilities across a number of different disciplines within asset management. Today, we'll be exploring SA high equity and SA low equity, and how we exploit short-term volatility to include assets in those portfolios. So we're ready to go. We've got 15 minutes, so I'm going to dive right into it. The first two slides are essentially to give you an overview of Mazi. It's our 20th year anniversary this year, so we've been in the business for a while. We have just over 51 billion rands worth of assets. And I think the most important takeout or call out is that we have capabilities across a number of different disciplines within asset management. Today, we'll be exploring SA high equity and SA low equity, and how we exploit short-term volatility to include assets in those portfolios. So diving straight into it then, just a very quick snapshot of Mazi Multi-Asset Management, the overview. There are essentially two of us who are responsible for the multi-asset portfolios. Some of you may have met my colleague, Kopana Maku, on an earlier webinar, and myself, and we report into Asanda, who's the CIO of Mazi, the group. In terms of our overview, we've been managing multi-assets since January 2020, so just over 6 years now, within the context of our 20-year evolution as Mazi. They've essentially been CPI plus mandates. Some of them have had constraints. What we would deem to be our flagship is an unconstrained multi-asset South African high equity offering. We've been managing that since March 2023. So we're coming up for our 3rd year anniversary. That particular product has got an annualized return of a shade under 19%. And over the last year has done about 37%. And on the back of this capability, especially in, let's call it, or primarily in segregated mandates, we decided to launch our collective investment schemes. Both our funds, the Mazi BCR Balanced Fund and the Stable Fund, have been in existence for just over 6 months. And you can see their specific benchmarks there, and the portfolio structure as at the end of January. I think the big call out at this stage is that when we did launch, we didn't go limit up offshore. Both funds could go to 45%. We were very constructive on domestic assets, and the Rand in particular. And that certainly has paid off over the last 6 months. Just in terms of the overview, just to give you a flavor, CPI plus 3 to 5 over a rolling 36-month view, or a period. And we think that gives you lower volatility. In terms of multi-asset, why would you go for that? You get both selection and allocation between different asset classes and potentially diversification benefits. We have built up significant internal capability across both stocks, fixed income, property. So we really do draw on our team for ideas going into these funds. And then maybe just a teaser, we do really look for asymmetrical return opportunities where the upside is greater than the downside risk. Most of you are probably familiar with the components of total returns. And I think what we've done here is just try to show you how we, at a top-down level, look at the different building blocks within multi-asset portfolios. So essentially, you've got cash, which is let's call it the least risky of the assets that go in. And essentially, what you get there is just income. That is the only component of the total return formula that you would get. Going up, you get bonds, and there you've got to avail yourself to the income opportunity you get and potentially the change in value, because that will have an impact on your returns. And then the most risky would be equity, where essentially there are 3 pots that you have to think about. One being income. What is your dividend up front? What is the growth prospect for a particular counter? And are you buying it cheaply? And are the prospects of good capital appreciation there going forward over your holding period? And I think what you will observe is that as you become, or you go up the spectrum from cash being the least risky to equity the most, your expected returns should improve But as you know, Eugene, there's no free lunch in finance. And with the increase in returns, you also get an increase in volatility. So your expected outcome, the range of possible outcomes will be wider. I think what I'm going to do then is just jump straight into an equity example, being Standard Bank, to give you a flavor. So, I think we're all familiar with Charlie Munger, who said that over the long term, it's hard for a stock to earn much better than what the underlying business does. And I think that is true of Standard Bank. So what I've plotted here is the share price of Standard Bank over 30 years and just the return algorithm in that little table there. So over 30 odd years, the median return has been about 18% for the group, which is a really solid compound if you think about it. They've paid out about 38% of their earnings as a dividend. So your sustainable business growth, if you take all of that into account, is around about 11%. What you have had over the corresponding period is about 2% taken away from a change in valuation. So over the very long run, what is important is it's the underlying business that will give you your growth, and change in valuation shouldn't give you too much over the very long run. Now, there are two things that should jump out at you right now. The one is that the share price certainly is a lot more volatile than what a sustainable underlying business is. And that is true of any asset that you look at. And the second point, if that is true, is at what point should you be buying or should you be selling? Because it's all very well to have a very long-term view, but there are periods, and the most recent being around about 2028. If you'd bought a company like Standard Bank, you would have had no capital appreciation for 6 years. So it's quite important that you know at the point that you're buying or selling, and whether it be equity, property, bonds, or cash, what you're paying for and what the prospects of beating or meeting your expected return projections are over a 3 to 5 year horizon. And I think, if we take that Standard Bank share price and we break that down into buckets, and those buckets are essentially 1 year returns all the way through to 15, you can see that on average, you're getting your 9 to 11%. That's the median return over every period. But you can see that around that, the dispersion in returns is going to be very high. Now, this is very common for equity. If it were fixed income, you would still get this funnel as you go down your holding period, but the volatility around the mean would be a lot less. So as active managers, what do we try and do? Okay, we try to essentially exploit what we think is overreaction. So, how is it that a blue chip like Standard Bank over any 1 year rolling period, okay, can give you up to minus 50% negative and up to 70% positive? What are the drivers of that? Because the underlying business hasn't changed that materially over the 30-year period. And it really then comes down to valuation. So, for us, that's very important. The second point is, and probably the most important point, is that if your holding period is 3 to 5 years, the area that I have elucidated in that box there, as active managers, you can essentially reduce that volatility. So if you have reasonably high conviction on a counter, if you're holding for 3 to 5 years, the volatility in the asset price is greatly reduced. In fact, a lot of the reduction in volatility comes down to that 3 to 5 year period, and going forward, the reduction thereafter is not as big. So we think that's an optimal horizon as a holding period to evaluate any asset that we put into our portfolio. So what do we try and do? We essentially are looking to buy assets that can give us around about 15% if they're equity. And for a company like Standard Bank, that means you can't just rely on the underlying business fundamentals. You actually have to pay a price that is lower to get to that. That is how you're going to get your return. So when we speak about asymmetry of returns, we're looking for essentially undervalued opportunities where the upside risk is lower than the downside risk. It's not to say that we are going to get it right all the time. Forecasting As we know, when earnings come out, analysts start to rejig their models. And historically, what happens is through a period of bad times, that's forecasted going forward over the 3 to 5 year horizon. But more often than not, that is discounted. And the valuation has more than discounted, let's call it a slightly benign outlook. So under that scenario, you are essentially buying an opportunity, which is essentially the green curve here. That the bulk, or let's call it more than 50% of the probability lies to the right-hand side of your expected return and a lower probability to the left, which means that your odds of achieving, let's call it your investment objective, will be, there's a better than 50% chance. Now, if you include a number of those types of opportunities, whether it be equity, whether it be fixed income, whether it be property, if you've got enough of those, okay, in your portfolio, the odds of meeting your investment objective will be better than 50%. And that's really what we're trying to achieve. If we can do that over time, we think that the results will take care of themselves because of the mean reversion in the valuation. We know that we're not always going to get it right. So we don't try and eliminate risk. And we don't necessarily get too predictive about the future. We're looking to invest with the odds on our side. And I think if we can do that repeatedly over time, essentially we are going to meet or exceed our objectives in terms of what clients are looking for in the portfolios. So with that, Eugene, I'll leave you a concluding thought for the day. And essentially, this is Howard Marks from Oaktree Capital. He's probably very familiar to many of the participants on the webinar. And he says you can't predict, but you can prepare. And a lot of what he has spoken about and written about is the kind of stuff that we try and inculcate in the way we build portfolios to ensure that we get a better than 50% probability of an outcome that will meet our expectations. And I think with that, I'll hand back to you. I was slightly under 15 minutes, and I was very, very cognizant of not going over the time period you gave us.